Should I buy into this fall? The answer may be yes, but what is more important is to know what to buy and when to buy. To know what to buy and when to buy, we should understand why the market is falling, why FIIs are selling into the market, and when can we expect the FII selling to stop. If you want to know the answers to each of them, keep watching. Assalamu alaikum and welcome to my channel. I am Shabbir Bhimani and I like to decode the market. In the process, I become a better investor and like to share the same on my blog and now on this YouTube channel. If you want to be learning to invest in the market, let's start with a disclaimer. If I am sharing any stock names, they are not a recommendation. They are just to put my point forward. If you want to invest in the market, you should consult a financial advisor. First, let us see why the market is falling. The market is falling because there is a relentless FII selling worth of rupees 4,000 crores every day in the Indian equity market. It has been continuing since last few months, and the main reason for FII selling is quantitative easing in the US, the rise of inflation in US as well as in India, Russia-Ukraine war, and the interest rates in the world is going higher. Some also argue that US might hit a recession very soon, and one of the reasons for FII selling is the recession in the US. I beg to disagree because every time a US hit a recession, the following year India has been doing very well in the equities. The reason India does well is because India is mainly an importer of oil and other commodities. So when US goes into the recession, the commodity price as well as the price of oil reduces, giving India a boost. The second question that we should look into is why FIIs are selling India. The main reason that I see is because of the interest rates rising in the US. So if I have a leverage position in the US, the rise in interest rates will demand more EMIs from them. So they may be reducing their leverage positions. The second reason that I see it is as the interest rates rise in the US, their average return from India as compared to the US reduces. So let me give you an example. Generally, a 6% hedging is to be done because of USD to INR. FIIs are interested in dollar terms return. So let's say they bring in the dollar at some point in India and then bring back the dollar to US. There's a difference in the USD to INR pricing. As an example, in 2010, USD INR was at 45 rupees and in 2020, it was around 75 rupees. So this 6% hedge for a last 10-year period has to be taken into consideration when they are calculating the returns from India. So once the US bond market gives them a 3% return, a 9% return from India is actually no return for them. So they prefer US bond market. Once the return from India is in range of 12 to 15%, they can make better returns for their investments, and that is when FIIs would prefer India. So the main reason for selling FII selling in India is because of the higher valuation in India, which made the returns lower, and then there is an increase in US bond market rate. So that is the main reason I see it as the reason for FII selling in India. The next important question is when will the FII selling stop? The Nifty EPS is around 800 rupees and it is currently trading around 15,000. So the price to earning multiple of Nifty becomes under 19 times. The GDP is expected to grow at around 8%. So a 10% increase in earning is a very conservative target. So 880 rupees or thereabout is the expected earnings for Nifty. So around 15,000 it becomes at 17 times 1 year forward earnings, which is a good valuation for Nifty. Historically, 12 to 15 times has been considered as cheap valuation. Under 12 times Nifty earnings is very cheap valuations. 15 to 18 times is considered as good valuation to invest, and above 18 to 21 times is above fair valuation kind of estimate by FIIs. So around this bracket of 15 to 18 times is where the Nifty fall should be restricted. It is trading at 17 times 1 year forward earnings, so I don't expect more than 10% downside from here. So considering this scenario, the FIIs selling should stop very soon, anywhere in between range of 15, 16 or 17 times 1 year forward earnings. The next question to answer is, should I be buying in this fall? We have already seen why the FIIs are selling and when can we expect the selling pressure from FIIs to ease. So the important question is the negatives that are there in the market. What are those negatives that can continue for next 3 to 5 years? And that will help you to decide should you be buying into this fall or not. So there are some questions that you should ask yourself. Will FII continue selling 4K crores in the equity market every day for the next 3 years? Will quantitative tightening suck up every dollar printed in COVID times? Is the inflation out of control no matter what we do to control it? Will the rise in interest rates continue to for eternity? Will Russia continue to fight with Ukraine for years? If all the answers are no for you, then this is the right time to invest. If any one of the question is a yes for you, then you should wait for it to become a no, and then you should start buying into the market. Finally, the most important question, what to buy and when to buy. A Nifty at around 15,000 is a great investment opportunity for us. As a retail investor, we should be investing in companies that can continue its earnings growth for next 3 to 5 years. If you are not sure which companies will have its earnings growth, Nifty ETF is also a good option, or a large cap fund. However, if you can handle volatility, a mid cap fund would be a better choice. When to buy? I think maximum downside that I see from here is 10 to 15%. So every fall in 2 to 3% in Nifty, you should divide your corpus into 5 parts and then invest for each fall. So let's say a market corrects for 2 to 3% from here and you deploy 20% of the corpus that you want to invest and continue that journey for next 10 to 15% fall in the Nifty. Finally, I have to ask, where are you investing? Share your thoughts in comments below.